All right, all right, all right. Let's get this show on the road. Happy to have everybody here. Glad you're here. It's good to see you. Already saying having a few guys check in and say hello. It's nice to see you, John. Nice to see you, Randy. We got a good little group party here for the first thing in the morning. So if you guys want to say hello, we'll make you famous. All right, I want to jump right into it today. I want to go through and I want to review the portfolio. And we got a lot to talk about because I not only want to review what we got going, I want to start looking for some new things to put some money into. All right, see if we can't take some profits, move them around, and put them somewhere else. Now, we've got so many good positions on. The last time we tried to take some profits, we didn't do it because we were like, well, we took a few, right? But we were like, we like these positions. We better hang on to them. So the first thing I want to do is I want to just start off looking down through what the positions are that we already have online. All right, so let's go through. And we have AMD. AMD is already breaking through on the B1. Now, I told you guys, I know you guys were all like, that's never going to break those blue lights, Lan. I promise you, it'll never break those blue lights. But it does. It breaks them. They all do. They have to. They can't not break the blue lights. All right. They're going to break the blue lights. And the blue lights there, this is the little indicator that we use to help us identify what is drive one, what is the counter trend, what is drive two. All right, that's how we know the break between drive one and drive two is with these little blue lights. They tell us. Now you can count them without the little blue lights if you're really good at it, but the little blue lights are kind of like cheat codes. Now, we have several systems that do this. All right, we have the charting application come in here. In Track and Trade, you have chart overlays, and it's the overlays that have these little breaking tools. Okay, so there's one in here called ATR, and we like the ATR, but it's a little bit kind of a weird one. So I usually use that one for day trading. I don't use it for the longer term stuff for position trading over a longer period of time. I kind of use that one more when I'm day trading. It's a little bit more aggressive, can be, but it can also be, you can adjust them, make them do whatever you want. But I use that one generally for day trading. Don't use it for this longer term stuff, because the longer term stuff I like to use the tools that are tuned into Aladdin's quant system, and I can't really make that ATR do that. It's kind of a different tool. So the tool I use primarily is called the bulls and bears. All right, that's my number one tool. And so I turn that on, and that does the red, yellow, and green. That's got the Fibonacci stuff in it. All right, so that's why the bars are red, yellow, and green in here. And so that also has the blue light system in it. So if you come into the settings, you can see it's got a little blue light. Show the blue lights in here and set it 72 progressive. So see, progressive 72. We've done a lot of back testing, and I've decided that that's about as close as I can get to the Aladdin system, to the quant systems that we like to follow, right? And so we're trying to reverse engineer what they're doing. And this is the closest settings that I've found. All right. And again, it's got red, yellow, and green. So it's the Fibonacci stuff. So it combines Fibonacci and Elliott wave, which is the foundational structure of everything that the markets are built upon. All right. So if you're new to trading and you're like, where do I start, Lan? I don't know where to start. Start with Fibonacci and Elliott wave. All right. Those are the two things you have to understand to know how to trade. If you don't understand Fibonacci, you don't understand Elliott wave, don't trade. Because right? I mean, it's be like telling you to go to Vegas and sit down at the blackjack table without knowing the probabilities of the rules and of the game, right? You can't go play blackjack and expect to win if you don't know what the probabilities are, what the game is. So it's the same thing in the stock market. The stock market has rules. It's a game. Now, is everything perfect? Does it always play the exact same rules? No. You go play the board game of life, right? Has the same rules, but it's a different game every time you play it. Same thing with the stock market. You have all these rules, you have all these things that have been designed that are around the game rules, but you have a different game every time. So the bulls and bears is a tool that really helps highlight those tools. Now, they can also get in the way a little bit. So sometimes I turn them off. So you have tools that you turn on, you'll turn off. Sometimes you'll use them, sometimes you don't. Depends on what you're doing, right? You have to do analysis, and so you use different tools for different purposes. So sometimes I'll turn that one off. So let's turn it off, and I'll show you why. So what this does is it tells you when the market's in a bullish trend, a bearish trend, or a neutral trend. That's very valuable to a lot of people, and it's got the blue light. But if we turn that off, you no longer have the bullish, bearish trend, neutral trend. All right, turn that off. You just have the special red and green bars, just the red and green bars, just like normal. But we're using Heikin-Ashi, which has a smoothing component to it. So we add Heikin-Ashi to it. Now we are using the daily chart. We're not using a range bar chart when we do our long-term trading. So this is how we set up our tools. But you'll notice in here, I turned off the bulls and bears, but I still have the blue light. That's because I turned on the parabolic SAR, because there's some people who they're not fortunate enough in their lives to have track and trade. And they're not fortunate enough in their lives to have the bulls and bears. So you can compromise, all right? You can use other tools to try and help you. And so this is called Wells Wilder's parabolic SAR. Now, I have taken the parabolic SAR and I have tuned it in to try and be as similar, as close to the bulls and bears blue lights as possibly can. So that's what these settings are. You can see the initial acceleration is 20, additional acceleration is 20, and the accelerated limit is 112. And if you put that on there, that's tuned in very similar to what the bulls and bears is. All right, so you can use the bulls and bears. You don't have the red, yellow, and green, but that's okay, because you can use the red and green bars that are in here, and they'll help you identify as well where those breakpoints are. All right, so you can kind of compromise. You don't have all the tools, but you can still do it without the bulls and bears. This is how you can do that. All right, so we're going to take it like this. I'm going to right click and I'm going to say save settings and apply to all charts. We're going to work today without the bulls and bears. And I'm going to show you the advantages and the disadvantages, because there's advantages to turning the bulls and bears off so you can see what other people see. And that's important too. So I'm going to show you some of that. All right, we'll turn the bulls and bears on and off, but that's kind of the idea. And that's how I've got my chart set up right now. Now, I've also got on the moving averages, I just use a 200 period moving average. Now, there's other moving averages that are important. All right, I know that the market likes to bounce off of 100s. There's 200s, of course. There's 50s. There's 28s. There's different numbers that the market likes to bounce off of, and this is a Me Too market. And I always talk about that. This is being a Me Too market. What's a Me Too market? A Me Too market means that the more people that use a specific tool, the more likely it is that a market is going to respect those tools. And so some of the more popular tools are things like MACD and stochastics and RSI, and some of those tools are very important because a lot of people use them. The stock market is very much driven by a self-fulfilling prophecy, but we're getting a little bit more away from that, and not so much into self-fulfilling prophecy as into quant style system prophecy. All right. The markets are being more and more and more and more driven by computerized systems. And you've heard me talk about this a million times, but the more and more systems are starting to be used is that Aladdin system. And so the great big boys, the ones that really matter, what we call the smart money, right? The really smart big guys, trillions of dollars in their accounts, literally trillions. All right. BlackRock has like, what's the estimate now? About $13.5 trillion. All right, we used to say $10 trillion, but I saw a new number. They've got $13.5 trillion in their trading account. Now, that's a pretty big trading account. They can pretty much make the market do whatever they want. All right. Now, there's a couple of companies like that. There's another one called Vanguard. Some of you probably heard of them. And then, of course, there's State Street. Some of you guys have heard of them. And those are just the three big ones. And there's, dozens of smaller ones as well. And BlackRock is famous for their algorithmic trading. All right. That's how they got so big, is because they use algorithms. They use trading systems. The computers trade for them. All right. Now, the way they use it, and I've talked to a lot of people who are on the inside, the way they use that is it's not like one big system that they just turn on and walk away. It's a managed system. It's still a managed system. They have levers and buttons, and they can turn things on and turn parts of it off. So they can turn on things and turn off things, and they can have a little bit of controls on this thing. All right. So it's not like a big monster that they just turn on and walk away. That's not how it works. So they can pick and choose, and they can turn features on and turn features off. And this market's something we want to have. We want bigger position in, so they'll push a button and it'll take over. They don't do the trading. They don't sit there like you and me with the mouse in their hand and click and buy and sell. If they want to accumulate positions in a market, they just turn on the accumulation, right, feature. If they want to distribute, they want to get out of the market, they turn on the distribute button, and they kind of control it to some degree. There's people who make these decisions, and it's not, I mean, it's on a big scale, all right? $13 trillion, big scale. But they can basically make the market do whatever they want. They can control it, all right? And these markets are programmed to do specific things. Now, I told you that one of the things you want to study on your own is Elliott wave and Fibonacci. But there's actually one system that is actually more of a foundational system than even Fibonacci and Elliott wave, and that's the accumulation distribution model by Wyckoff, all right, Richard Wyckoff. So you want to study that one first, but it kind of goes hand in hand with the Fibonacci and Elliott wave stuff, because the way they make the process of the accumulation distribution model is with Elliott waves and Fibonacci's. All right, let me show you what that looks like. All right, so this is what the Wyckoff looks like. All right, so this is the basic structure, and this is what we call the accumulation phase. And so it's just a simple process of buying low and selling high. It doesn't matter if you have $13.5 trillion in your account or if you've got $500 in your account. You have to, the only way you make money in this market is you buy low and you sell high. That's it. Buy low, sell high. And you can do exactly the same thing as BlackRock can with their, multi-trillion-dollar account and a big computer system. You don't have to have that big computer system. You just have to understand what that big computer system's doing, and then you can do the same thing, or you can fade it. There's nothing wrong with fading it. A lot of us fade it, which means we do the opposite of what they do, but we do it logically. We know what they're doing, and we know what the market's going to, theoretically, we know what they're doing. And not that it's going to happen the same every single time, and nothing's perfect, all right? But we have an idea of what the market's going to do, and so we can fade it. We can do just the opposite of what they're doing, and we can take advantage of it, but we do that eyes wide open so that we can take advantage of what they're doing, all right? So they have what they call the accumulation stage. And it's nothing fancy. All they're doing is buying low and selling high. And you're like, well, Lan, I buy low, sell high. Do you? Do you really buy low or sell high? Or do you buy high and try to sell higher? Or actually what most traders do, most retail traders, they buy high and they don't sell. Okay? They buy high and they don't sell. So what happens is the market comes up into this region up in here. They buy up in here because, they want to buy a market that's doing well. Or they might even, be smart enough to buy right in this region here. And they'll buy it and it'll go up and make them a little bit of money and they're all happy. And then the market comes back down to basically where they're break even. And they're like, oh, wow, I'm just going to hang on. I'm not going to get out, right? Anticipate another rise in price. Unfortunately, the market generally goes down like this and they end up losing a whole bunch of money and then they sell. Okay, so they buy here or they buy up here and they add in. So they buy here, they add in up here, and they end up down here. This is where they sell. All right, so they sell down here. So that is a process that is designed. I mean, they kind of shake you out and make you do that. That's what those big quant systems are designed to do, right? They take your money. They're designed to take the retail traders' money. They've got all the money in the world. They got, BlackRock alone has $13.5 trillion. So they got all the money in the world combined. The only money they don't have is yours. And so they want that too. This, the greedy bastards, but that's what they do. So the only way they make money is to take somebody else's money. For every winner, there's a loser. And usually the retail traders are the losers to the big quant systems. But if you understand what they're doing, you can be on the winning side. So it takes a process of learning and understanding. All right. So the base structure is the Wyckoff accumulation distribution model. That's what you're seeing on the screen right now. And so they buy down in the low regions, accumulation stage. And then as the market starts to rally, they start to sell out. All right. They sell all the way up that trend. Well, who's buying all the way up that trend? Well, the buyers are the retail traders. They're buying all the way up. As the market goes up, they buy. Well, for every buyer, there has to be a seller. Well, if the market's in a big rally like that and it's going up, who's selling? Who's selling to all the retail traders? BlackRock is. Why? Because they already bought down here in the accumulation stage. That's why they call it the accumulation stage. All right. They accumulate and then they sell out all the way up while we're buying all the way up. That's where you fade. Nothing wrong with buying on the way up of this trend. You just have to realize where these stages are. All right. Stage 1, stage 2, stage 3. That's the Elliott wave. That's what we call drive 1, drive 2, drive 3. Drive 1, drive 2, drive 3 occur up this trend right here. Okay. Up the accumulation and distribution. Now the accumulation is down at the bottom. We buy low and then they sell out high going up. So that's up through the accumulation, or what they call the distribution stage. All right. Now, you can go through another accumulation stage to the short side. See how this is the accumulation stage start of the accumulation phase right here? That's going down. That's a short position. So they'll take on a whole bunch of short positions and then buy all the way down this trend. That's why it's the accumulation at the bottom, accumulation at the top, accumulation back at the bottom again. They accumulate here, but they sell out. They accumulate here, which is short positions, and then they sell out, which is buying back in. So they buy out all the way back down until they're back down and they start the whole process over again. All right. So these are the patterns that we look for. Now, if you don't think this is a real thing, I want to show you something. Let's come in and I'm going to show you Tesla. Tesla just happens to be, look at this. All right. Now, this is Tesla in the last accumulation distribution stage. Look at this. If I can shrink this down. You tell me that's not exactly what we have here in our drawing. Now, you would think I look at Tesla and drew this, right? But I did not. We drew this picture years and years and years ago. And look at how this thing comes in. This is the accumulation stage. It goes up through. You can see it going up through. We got the little, it's almost like they followed it like a train on rails, right? When I say that, that's what I'm talking about. Look at this thing. Come down here, right down in here. What did I do? I started buying up in Tesla. I told people buy a lot of Tesla right here. It's getting ready to rally. We're going through the accumulation stage. See that? That's Tesla. And it happens over and over and over again. This is a very common pattern that we watch and we see. All right. So, and then of course it turned and it started to break higher once again. Now we're in the first drive stage of Tesla going back up the other direction. Now I know there's been some fundamental goof offs with Elon and his little fight with Donald Trump and all that kind of stuff. All right. But these things happen. And so they come down. And if you look, you're saying, oh, well, lad, this is all a bunch of, this is a bunch of bull hockey. No, it's not bull hockey. All right. Look at this. The little fight with Elon Musk right there. That was his day that he was getting a little tiff with Elon or with president. And look where it came down to. They brought the market right down to the Fibonacci sequence of 61.8. That's the golden ratio. Hold on a second. I'm losing my voice. Give me 1 second. I'll try not to forget to turn the microphone back on. All right. Are we back? We're back. All right. So look at that. Just like, I'm not going to say it, but I got to say it. I can't not say it. Just like a train on rails. It's in the drawing. It's right out of the manual. You couldn't draw it and make it any more perfect. All right. So I actually had, believe it or not, in my real money account, I actually had, and I think we actually might have done it in the demo too. I had a limit order sitting right there to buy a whole bunch of shares at 61.8 because this thing was going up. And I'm like, if this thing comes down and hits 61.8, I'm going to buy a whole bunch of shares. I had no faith that it was going to do it. But it did. It came right down. Literally almost to the penny of where I had my order sitting there to buy a whole bunch of shares of Tesla at 61.8 because I'd drawn my Fibonacci ruler in there based on the Wyckoff accumulation model. And I'm up big chunk of money now. All right. As this thing market starts to rally. So that's the name of the game. You got to get in there and you got to play these odds. It's like sitting at a blackjack table. Where are the odds at? And put your orders in at the high probability locations. Does it mean it's perfect? Could it have continued to fall and flush down? And I not make money? Yeah, it could. But the odds said that it was going to come down to 61.8. Now, whatever caused that to happen, Elon's fight, BlackRock's algorithm, one using the other to make whatever they wanted have happen, the market fell to 61.8, exactly to the penny. Why? I'm telling you why. Because it's a computer system. It's a mathematically modeled computer system. Yeah, but Elon and Donald Trump getting in a fight, how could that be programmed into the computer system? It just is. They took advantage of the fact that the market's flushing down. They drove it down to where when the market started to flush, all the way down to a certain location. The computers see the mathematical model. They didn't make the market fall. They just knew that this was the probabilities of the market happening. That's what markets generally do. Now, they don't always fall. Sometimes markets are too strong and they don't fall all the way to 61.8. But in this case, they did. And so that's where the computer systems start to buy. So when the big computer systems hit their specific target points, just like I had my target point there, they have their target points there too. So I've done this so many times. I've been doing this for nearly 40 years. I see the markets go to these numbers. I put in my orders at these different levels. And that's what they do. They put their orders in at these different levels. So if you have somebody with $13 trillion putting on a buy orders at 61.8 and the market comes down because of whatever reason, tiffy tuffy with Trumpy and Elon Musky, right? They getting a little tough it and the market flushes down to 61.8. Well, it wasn't those guys, those two guys that caused the market to fall. It was the retail traders, most likely selling out of their positions, scared of this little fight. But it wasn't the big computer systems that stopped. It was the big computer systems that stopped the fall at 61.8. Why? Because they already had predefined orders to buy at 61.8. They already had predefined orders to buy at 50.0. They already had predefined orders to buy at 38.2. It's just programmed into the system. So when the market came down and hit 61.8, because all the retail traders are jumping out of the market because they're scared that Elon, and because they listen to the news, they're scared Elon and Trump are going to cause Tesla to flush down the toilet. They all start bailing out. Well, that causes the market to go down. But what causes the market to turn and start to go back up? Well, it's the quant systems that have all these orders sitting at 61.8. They have predefined orders sitting there at 61.8. If the market comes down to 61.8, the quant systems are going to buy. The market came down to 61.8 because the retail traders were bailing out, causing the market to go down. It hit 61.8. That's where the big quant systems start to buy. So when the big quant systems start to buy, well, there's no more sellers because the quant systems are buying up everything that's being sold, forces the market back up. That's why it works. All right. That's why it works. It's because everything is predefined. Now, is everything always predefined at the exact same numbers? No, there's not orders just at 61.8. I can guarantee you they also had orders down here at 78.6. There were a whole bunch of orders sitting at 78.6, just like there were a whole bunch of orders probably sitting at 38.2. They started doing a small amount of buying at 38.2, but there were more sellers than there were buyers. Their little quant systems didn't buy enough at 38.2 to stop the slide. So when it hit 50, they started buying some more. When it hit 61, man, that's a big number. That's the golden ratio. Those quant systems will kick in and they'll start buying like mad at 61.8. And that was enough to stop the slide. So it stopped it right at 61.8. Those quant systems start to buy bigger positions and the market started to rise. That's why you have these numbers where it'll bounce off at 38.2. It'll bounce off at 50%. It'll bounce off at 61.8. It bounces off of these important numbers. Why? Because they're mathematically calculated into the big quant systems. When the market starts to fall down because all the retail traders are scared, they get out of the markets. Those guys start buying at these different levels. And the stronger the downtrend, the farther it'll fall. And the bigger the purchases will start to be by the bigger boys, right? They'll accumulate more at a lower level because they like to buy low and sell high. Retail traders, we do just the opposite. We like to buy high and sell low. So we buy right up in here where we think the market's doing really great and really wonderful, right? And so we like to buy lots of markets that are way high. And then as they start to flush for whatever reason, because Elon gets in a fight with the president, causes the market to flush. Well, those systems are already set up to start to buy, all the way down that trend. And the further down that trend goes, the bigger the buying power is. And at 61.8, that's a big buying number. They buy a lot at 61.8, which is why it bounces at 61.8 a lot. All right. And it's just because the big quant systems are set up to buy at 61.8 retracements. All right. That's why it works. It's like, this doesn't work, Lan. It does work. I promise you. And how do I know this? I worked at the Board of Trade for about 10 years, and I sat in the classrooms where they taught this stuff to the guys that wrote these systems. I left that place and I wrote this program. See, track and trade with all of this stuff built into it so that we can do this. When I left the Board of Trade, that's what I did. I started a company, wrote all this software so that we could use all this stuff that I learned at the Board of Trade, and I could use it myself. I didn't make this software for you. I made it for me. The only reason I sell it to you is so that I have you guys help me pay my programmers so they can write the software that I want. Of course, I've sold the company now. I don't own it anymore, but I could care less about anybody else. Excuse me, man. Hold on a second. I wanted the software for myself, all right? But I needed your help to build it because I didn't have enough money to pay programmers to write software for me. So I started selling the software, became a software company. That's what it was all about. And so I wrote all this stuff. We created this software program from the stuff that I learned at the Board of Trade, sitting in all those classes. They taught these guys what accumulation distribution was. They taught them what Elliott wave was. They taught them what Fibonacci was. They taught them how to do all this stuff. And then all these guys, me included, we all left the Board of Trade, right? And we went out into the world of the finance world and we built our systems. Many of these guys went to New York and they built the big systems for the big firms back there. That's what they did. I came, started my own company, wrote this system. Hey, this is what they taught me at the Board of Trade. This is how you're supposed to trade. This is how you're supposed to do it. Write the software. And then I come and teach you guys, hey, this is why we wrote the software, to do this. Now, you go buy the software so that I can make enough money to continue to write the software and make the software better. Started a software company. That's what I did. All right. That's how this is done. That's why these systems work. That's what I'm teaching you. I'm teaching you how they programmed these systems, and where we learned it from was at the Board of Trade. Chicago Board of Trade is like the temple of the financial industry, right? That's where we went. And I worked at the school there. I wasn't a trader there. I worked at the school there. All right. So that's the way it works. Pretty cool. All right. Let's go look at some more. So that's drive one. That's the first drive on the Elliott wave. There's drive one. There's your counter trend. We're looking for drive two. All right. So we're going to label this. Let's come and look at AMD. We have a position in AMD. Delete all this. And you can see that we've come down here and we bought right here at the bottom, right at the accumulation stage. We picked up an option right here in anticipation that this market was going to start the first drive up out of the accumulation stage. Now you look down here at the indicators. I got an indicator down here. It's called the Chalkin money flow. Chalkin money flow. All right. See that? This tells you where the accumulation stages are, where the big boys would start to buy or accumulate positions. Now, of course, coming down, there's also a ways of knowing how far down that the market might come. This one came down a lot of drives, a lot more than I anticipated. 1, 2, 3, 4, 5. Usually we only get three drives down. And oftentimes we'll just get 2. So we look at the probabilities of what the market's at down in here. But this was a nice little pattern. This is where we get our little head and shoulders formation in there, for those of you who know what head and shoulders are. And I was expecting this to come right up in here and break and give us a little right shoulder. It didn't give it to us, but it gave us this little natural break right in here, right? So anyway, this is where we got in with our long call. And now this market, this is one of those situations where we thought, okay, we're gonna see this market come in and come back to the 61.8, right? Or down into the Fibonacci sweet spot. And we were looking for this market to come back down in here and where we could buy in on this pullback, just like we did on Tesla, right? But it didn't happen. It didn't happen. Why? Well, the market's too strong. Too much positive news coming in for AMD, all right? We're on the Trump train. The Trump train didn't drop far enough for us to get down into 61.8, or to put our orders or fill our orders at 50.0, or to fill our orders at even at 38.2. Now, we don't go all in, all right? We don't go all in. Now, if you're going to trade options, we went in with 5 down in here. We was a pretty good position. We were pretty hopped up on this one. We thought that was pretty good. But right in here, we could sell out, but we knew, well, we didn't know, but we knew that this was what we call the A1, all right? And so we went through, this is the A drive, the first drive, all right? The reason I call it the A1 is because it's the first drive. Now we're going into, on AMD, we're going into the B drive. So this is called the B1, the first entry point opportunity on the second drive. Now, how do we know it's the second drive? Well, because of the mathematical model that we've used to recreate what those boys learned in Chicago and went back to New York and what their settings are. All right. So all we're trying to do is figure out where they put their settings on these different tools. And you're like, Lan, those guys in Chicago, those guys in New York have more sophisticated tools than these little retail tools. No, they don't. They have the exact same things we have. The reason we have them is because they have them. It's not the other way around. The reason we have parabolic SAR is because they have parabolic SAR. The reason we have the bulls and bears is because they have the bulls and bears. All right. The reason we have these tools is because they have these tools. It's not the other way around. It's not, oh, we have all these little retail tools like parabolic SAR and bulls and bears and chalk and money flow. Well, I wonder what those guys up there have. Why do you think we have them? We have them because they have them. That's why we have them. All right. These tools were created by individuals who are from that world. All right. It's not like some guy on the street wrote MACD. The guy who wrote MACD was from the world of New York. All right. New York, Wall Street. He was a big mogul that wrote that indicator for Wall Street traders and for quant systems. Why do you think we have these systems? That's why we have them. All right. That's why they work, because it's the ones that the guys have programmed into their quant systems. All right. So what we do is we want to use the same tools they use, right? So that we can try to reverse engineer and figure out what they're doing. So if you understand their logic and how they're trading and how they've programmed this into their computer systems, then we can do it too. We can make money. We can follow along, do what they do, or we can fade them, do differently than what they're doing. Now, remember, they go through an accumulation stage. So down in here, they're buying all through here. All these little green spots down in here, this is where the big boys are buying, which is buy low. And then see these red spots here on the chalk and money flow? This is where they sell out. All right. They're selling through here. Now they go through a reaccumulation stage, and that's probably what's happening right in here. Right. So they'll come in here and they'll start to buy up some more right in here in anticipation of a rise in price. Once the market takes off and runs, starts to go up, what do? Retail traders start to buy. What do the big boys in New York do? In Chicago, what are they doing? They're selling. They're selling to us. Now, as long as you understand that, you can still make money by buying. All right. They bought all through here. They bought all through here. They were buying all down through here. They dollar cost averaged all the way down through this thing. They had huge positions in here. Now they need the market to go up so they can make money, so they can sell it out. So they start the market. They give a big run. Market starts to go up. They coordinate that with news. They create the news. There's all kinds of things that they can do to help retail traders make decisions to start to buy so that they can sell to you. And that's the way they make money. Every time you buy, you're probably buying it from one of the quant systems who's selling out one of their positions down here. And so as we buy, they sell. They sell all the way up the uptrend. We buy. Now that's okay, because if that market keeps going up, we can make money. But we have to realize that the big boys are selling. And once they get up to the top, they're going to stop selling and the market's going to flush, right? Because they need to buy more. So they buy more, and then the market rises, they sell it all out. That's how the market works. And so retail traders are the buyers up the trends. The big banks are the sellers up the trends. When the market flushes back down, we sell out, they buy in. Does that make sense? When the market starts to rally, they've already got all their shares. We buy in, they sell out. They sell to us as we buy as the markets rally. So as long as you understand that's what's happening, You can be wise and say, well, I know they're selling out, which means that at some point they're going to run out of shares to sell and the market's going to stop going up. And at that point, I need to get out of my position, or I need to anticipate that, well, I'm going to sit through a drawdown in anticipation of the next run. You could do that too if you want. Okay, so that's, as long as you understand that that's what's going on, you can make your informed decisions. Now, does it always happen perfectly? No, it doesn't happen perfectly every time. Like, we wanted this to come back a little farther. We wanted it to come back into what we call the accumulation stage, or the delta cone of probability, right? Which is the Fibonacci between 38.2, 50, and 61.8. Now, there's a lot of orders sitting on the books at 38.2, 50, 61.8. Now, yes, I know there's a lot of guys who will sit and look at different tools that'll tell you where these orders sit, but you can pay for those services if you want to, but that's all it's going to tell you. Oh, there's orders sitting at 38.2, 50, and 61.8. Oh, well, duh. All right. Just because there's orders sitting there doesn't mean the market's going to go to it. It just means that if the market goes to it, those orders will get filled. All right. So that's called your level 2 data. But for us on the daily charts, not that valuable. Maybe a little bit more so when you're day trading. All right. So that's the name of the game. So that's the one first drive, second drive. And usually we get 3 drives. So we get the A drive, the B drive, and then the C drive. And so right now, and then of course these things are fractal, which means that they have little drives inside of bigger drives. So inside of this, we can anticipate, where do we think this thing's going? We use these other tools, the Fibonacci projection tools. All right. And this is how they do it too. And that's why we have these tools, because we're just trying to do what they do. All right. And how do I know? Because I was there. I learned from them. All right. So we come in here and we lay that in there, and that's our Fibonacci projection. And we're going to go off this second one here. So this is the Fibonacci projection. This is where we're going to anticipate if the probabilities work out the same as it did on the first run. So A drive was this big. We're going to anticipate the what we call the reflection. All right. So the pullback point and then the reflection back up to this point. So we're going to say these guys are going to probably run it up to this region up in here somewhere. Now, 100, 130.9 is the golden ratio to the upside, just like 61.8 is the golden ratio to the downside. Now, this one didn't make it all the way back down to 61.8 to get filled. And so we have to take into consideration that, hey, it didn't get all the way back down to 61.8. If it would have gone all the way back down to 61.8, they would have bought a lot more shares, right? And the market would have had a big push up. Of course, if that's the case, then this thing would have been down. We'd take our little Fibonacci projection tool and we would have put it down here, right? And we'd have a different projection. And the mathematics would have been different. But since they didn't get it to go all the way down there, they don't have as many shares, all right, as they would like. So the big firms didn't get as many shares as they'd like. They sold out. The market didn't flush far enough for them to buy more shares. So now that the market's running again, they might not have as many shares as they would like. Therefore, if they start to sell out some more going up this way, they might sell out sooner than they would have had they had the opportunity to buy more shares. Think about that, right? You always have to think about it from their point of view. Anytime you want to think about what is the market going to do, how am I going to make money in this market, you have to think what happened to the quant systems. Where did they get their shares? When did they accumulate? Where do they sell out? How do they make money? What are they doing? What are they thinking? What has their system done? Where are they sitting right now? Right now, when I look at AMD, I'm like, all right, this is a strong market. The fundamentals are probably pretty strong. I mean, if we want to go look at them, we could. We could go over and look at the fundamentals. In fact, let's do it just for academic purposes, right? That's why we're here. We're in a school. Let's go pull up the fundamentals. Let me see if I can figure out a way to get those on the screen real fast. Here we go. All right, so we're going to go look at the fundamentals. The tool I like to use for the fundamentals is called FinViz. All right, it's a good little tool. It's got kind of a decent little charting program in there. It's not the greatest. I mean, it's good enough to look at. All right, it's good enough to look at. You don't really trade on it. You don't really do all of your analysis on it, but you can kind of draw some tools on there. It's not bad. All right, it's not a bad little tool. It's one of the best on the market for being a for being just a little static chart that you get on an internet website. That's about the best you can get. All right. So we're going to come down here. But the nice thing they do have is they have all this fundamental information. All right. Now I'm a subscriber to this, so I don't have all the ads popping up. And as a subscriber, I get a little bit more information. They give me some of this stuff down here that you don't get when you have the free version. But I like this. You can see in here, these guys, don't ever pay attention to these guys downgrading and upgrading. The upgrading will make the market move up, but the downgrade, they downgrade stuff and then the market shoots up all the time. This stuff is like, it's like 50-50. And it's like throwing darts at this news stuff is bullshit. All right. This is what you really want to look at. You want to look at your earnings per share. You want to look at your sales in billions. They're making billions of dollars. All right. And then their shares outstanding. Now, this I don't like to see. All right. When it comes to the fundamentals, I don't like to see their shares outstanding going down. That means they're buying their shares back. So that is also what can cause the market to go up. If they buy their shares back, they're buying, right? So they're causing the market to go up. So if the company themselves starts buying shares back, it's an artificial inflation of the underlying stock. Now, a lot of people will tell you, oh, they're buying their shares back. They're doing this really good thing. Oh, it's great for this. It's great for that. Well, who the hell do you think's telling you it's great? The people who are buying the damn shares back. It's not great. Anytime a company starts buying their shares back, that's not good. I don't care what they tell you. It's not good. All right. It's not good that they buy their shares back. Oh, but Lan, they're sharing their income with they're keeping their yeah, that's exactly what they're doing. They're propping up their stock so that you won't sell it. So they buy some back. Oh, shit, our stock's going down. Why? Because our sales are flat. 394 billion, 383 billion, 391 billion. That's not growth. So what do? Oh, well, don't want our stock to go down. We're not making any more sales, so we better prop up our stock so that the people don't sell it. So they start buying the shares back so the prop stock goes up. It's an artificial inflation. All right. This is not good news right here. What we're seeing here is the earnings per share are flat. Sales in billion are flat. Shares outstanding are going down. They're buying their shares back. This is an artificial inflation on this stock. All right. Be mindful of that. That's what that means. All right. I don't care what they tell you. You don't listen to the jackals in the news because they're going to tell you what they want those guys to tell you so that you will perform the way they want you to perform. All right. They want you to hold on to those shares. They want you to buy into this company. That's what this is telling us. It's exactly what that's telling you. This is an artificial inflated market. All right. Does it mean you can't trade an artificial inflated market and make money? No, hell no. They're going to artificially inflate it, make money on it. Just realize that it's an artificially inflated market. They're buying back their own shares and they're not selling any more product, but the stock's going up. Why are stocks going up? Well, because they're telling you that it's a good market. All right. So could it be? I don't know. Possibly. Do they have contracts that are going to suddenly make them start selling more chips? Maybe. Maybe they've got good contracts. Maybe they got good chips. I mean, lots of companies are buying chips, right? So maybe they will. Who knows? But right now, looking at the data, it's an artificially inflated market. So the market's starting to go up. Just be mindful that it's an artificial inflation. Now, how much do you want to dump into an artificially inflated market? It's going up. We're in an A1. We got our shares. This is going into a B2. They didn't get as many shares as they would like to have bought in a market manipulated state, right, to get it to come down into here to buy more shares. So they're running out of shares. It's starting to rally, which means to me that they probably won't hit 130.9. Why? Because they don't have enough shares to get it up there. It's artificially inflated. And 130.9 is for the opposite of all that, right? You need to have a really good market. You got to have, but it doesn't mean it can't go up there. It certainly can. Still doesn't mean it's not going to be an artificial inflation, but 130.9 is probably not going to get reached this time. They weren't able to buy more shares. And so the market's starting to rally again. And it's an artificially inflated market. I don't expect it to go to 130.9. Doesn't mean it can't. That's Lan's analysis. So I'm looking at the market to come up into this region here, maybe 90, 61, 90. We may not get a big, huge push up in there before we get the other drop of the shoe, right? And then the next rally. Now, hopefully on this rally, we'll take our Fibonacci ruler, we'll put it in there. It'll come up to maybe, let's say it goes to 90%. Well, they'll want the market to fall a little bit down in here where they can buy some more. And if they can buy some more down in here, they may give it one more nice big push up and they can run it up the third time. Okay. So we don't know what they're going to do. We're just trying to, what's in their head? What are they going to do? They know this stuff too. They know the fundamentals. They know that the AMD's buying their own shares back. They know this stuff. Why is the market running? Well, it's running because everything else is running. We're on the damn Trump train, right? Chips are an important thing. Everybody's buying the chips. So they're making money on it. So that's why you get in there, jump in there, fight, win, win, win. That's how we read these markets. That's what you do. You have to think about it like you are one of them. All right. That's enough for the lesson today. Let's go through and look at the markets and see how they're turning out. All right. This is our BMW, our BMY. This is our one big mistake that we made. We bought too early on this thing coming down. We bought right there. And this is where all the other markets started to turn. So this was a timing thing, and Lan didn't look at his own indicators, and we bought right there. So we're looking for this market to turn and rally and come back and give us a little breathing room. I don't think we're going to ever make this thing back, but we did sell a whole bunch of covered calls against this thing as it came down. So we're only down actually about $1,000 on this. Actually about, I think we made, yeah, something like that. I could pull up the spreadsheet, but in the interest of time, I'm not going to go into that detail. But we're down about $1,000 on this market. We're looking for it to come back. We got 66 days. We're running out of time. I doubt we're going to, I don't know. We'll see. I doubt we'll make any money on this thing. We'll just try to mitigate our losses at this point. We're selling some premium down here, collecting $260 profit and loss, market value. What is that? Oh, we sold two. We sold two. That should be profitable for us. Received 260 profit. Oh, we're up 245. There's only $15 left, so we could take that off. We got all our money out of that one. So we need to go to our spreadsheet. I better write that down. I'm not going to go do it right now. How much are we taking? 200. Well, let's see what it gives us. Let's just mark it out of it. So we got our full profit on that. We got 242. So Lan's going to write down 242. I'll go put that into our spreadsheet. So that takes another $242 off that loss. We could put another one in there. This is coming up. This is our A1, isn't it? Because it's coming back down. This is drive 1, drive 2 down off the top. We got our ABC. We got a little head and shoulders in here. And now we're looking for this market to turn around, start to rally. It's breaking above the previous high. That's what we want to see. Higher highs and higher lows, lower highs and lower lows. So we're making higher highs. We got a nice run today. We're coming back. That's good. We'll just let this thing make money. If we wanted to, we'd come in here and we could sell another put. Let's, oh, wrong tab. We could sell another put right down in here. I don't know how much we'd get out of it. Let's go 38 days. We got 66. Let's go to the options chain. 38 days puts. Ugh, look at the volume. Open interest is good, but the volume is only 5. That sucks, but the spread's not bad, 9. So if we sell a put down in here, that would give us $72, $90. Ugh, these are worthless. That's because the market's got such a big rally today. Let's wait and see if we don't get a pullback day. We get more money out of it. All right, so that's where we're at here. That's our worst one, Bristol Myers. All right, we're not AMD. I'll go back to that just real quick. We're not going to sell out, obviously, right here. We're going to anticipate a rising price. We'll let that thing run. So we got Salesforce in here coming in. Oh, look at Salesforce. We got a lot going here. Let's get rid of some of these drawings. See what we've got. So we're coming in here with the first drive. So this is drive 1. We put this Fibonacci ruler in there. Let's get rid of Donchian channels for now. That's just to clean up things. And we're going to take our Fibonacci ruler. And we're going to run from the low to the high. So where did it come back down to? 61.8. Just like let's all say it together. La la la, like a train on rails. Okay, this thing is just performing admirably. All right, so it came down, it's hitting the blue lights. This is Salesforce. We're going to take our Fibonacci projections. It's just a projection. We don't know for sure what it's going to do, but we're going to project it off of this. Let's just go off of this one right here. And we're going to go up to the peak here, back down to the 61.8, and that's where our train rails are. All right, so our train rails are right there. Get rid of this little arrow here. And so this is where we anticipate this market coming to. Now we've already got in here. We put this in a little earlier. This is our, how much money are we making on this one? Let's see what our positions are. We need to close out some of these because the market's starting to go back up again. So we need to take, this is our sold call right here. So we need to take that 850 off. Liquidate that one. This is our, what is this one? Buy 40, cost basis 10,000. Oh, that's our long call. All right. So we got 283 days left on that. Where is it? Oh no, that's our position. We got 40 shares. Okay, those are just shares that we bought. We bought that when we were demonstrating the day trading. We're up 40. So yeah, then we got 40 shares. Well, we might as well hang on to them. We're up $400. Okay, this is 10 days till expiration, 10 calls. How many days? Oh, we only have 10 days till expiration left on those. We might as well take those off there. Well, I don't know. The market's going up. There's no reason to take them off. 10 calls. Is that what we got? 350 and 320. That's not what it looks like on the screen. That's weird. So I'm going to buy a call. Oh, sell a call. There's our. Oh, 10 days. Bought a call and we sold a call. So that was a spread we got in there. That's this thing up here. Oh, that's what that is. So that's up $227. Market's going to rise. We only got 10 days left. It's not going to make it all the way up there in 10 days. We'll get our full profit. Well, there's nothing left in it. We've got all of our profit. We've received 98 here. There's only $7 left. We received $330 here. There's only $11 left. There's no reason to keep it. We got all our money. Let's close it down, boys. All right. Salesforce, that's our long position. Buy a call. So our call with 283 days left is down 200. That's this call right here where we got in on the A1. A1. That was a mistake. Oh, that's all right. We'll use it. Oh, Lan can't push the buttons today. So there's A1. So that means this here is B1, right? B1. There you go. So there's your B1. Has it broke it yet? It did. It broke it. So it's on its B1. It'll probably give us a little small rally and a little pullback, and then it'll take off over here. That's probably what we'll see. Maybe something over here. I don't know. We'll see. It might take off right here. It might just take off and go right here. If we wanted to, we could buy another call. Do you want to buy another call here on Salesforce? Double down on Salesforce? Probably could, because it's going to go up. It's just how fast is it going to go up? That's the question. Let's price one out just for fun. We took some money off of here. Put another 100-dayer on there. These are 283 days. I don't want to really sell it. I don't want to sell right now because I don't want to. We could sell a put. But let's just look at buying another long call, 100 days out, $1,500. Oh, that's a put. I don't want to put. I want to call. Ooh, look at the put spread on that thing. That's a big. Look at that, guys. Look at this. The put costs $1,500. The call. Come on, show it to me. $2,145. Wow. The skew between the put and the call is unreal. Look at the historic volatility right here. It's kind of, where's my mouse? Come on, mousey. Yeah, so many damn monitors. My mouse gets lost on one of them and then it's stuck over there. All right, so we're at 16.65 on the historic volatility. It's been as high as 31 and as low as 9. Ugh. Let's put in, what have we got in here? I wonder if we can, the thresholds. This 31 is the high. I wonder if I can put this in at 31 is the high. Let's put it in at 25. And then we'll put this one in 9. Let's put it in at 15. So that's our threshold right there. That's kind of on this one. You have to adjust those because this will change when it goes up higher. You have to move those around. But right now, we're just kind of in the dead center, neutral, implied volatility. Historic volatility is going up. It says it's lower. I would much rather buy it. Oh, look, that's why, way down there. That's expensive. The point that I'm trying to say here is that, like, this is $2,000 to get in today. We don't want to do that. That's too expensive. The theoretical value is 2,500. Well, you can buy it for 2,100. If you go to the puts, 1,500, 1,700, you can buy it for less than what it's going for too. The theoretical value. Let's go up and make sure that we've got our file. No, it's view. Show dynamic multi. What is it? Where is it? Oh, maybe it's over here. No, it's not. It's got to be in here. I'm looking for the interest rate. I'm not sure what the interest rate is set at for the. There it is. Options calculation interest rate. It's set at 4.33. Let's go see what it is. And we're looking at it 100 days. So that's 90. That'd be 3 months. We need 3 months. Today is the 9th. It's 4.44. So we said 4.33. Let's put it at 4.44. Not that that's going to change anything. Yeah. Didn't change anything. There it goes. So changed it by 10, 30 cents. That's all it changed it. Big deal. 15. I don't know if I want to buy that right now. I don't know. It's green, but I don't know. That's 2001. They say 2,500 is what it's worth. Let's buy one anyway. Let's just buy one 100 days out. All right, buy one 100 days out. We'll just add one to our. How many have we got here? Oh, we've only got one. So we'll just buy one more. I don't know if that's going to be a good deal or not. We're going to find out, I guess. I don't want to sell my call against that yet. I want to see it rally up. And then once it gets up there a little ways and breaks up into this 190, 100, see, it's pulled back far enough that they're able to get a bunch of shares in there. So they could push this one up to 130.9. So if that's the case, our call will be good. So that's A1. This is B1. All right. Cisco. Look at that, baby. Rock and roll. Now, if we got our money out of here, no, we're probably down on this. Oh, no. We paid 50, received 160. Positions. This thing says we're down $30. That's because it's rallying so hard. We might get in trouble on this one. We put that little thing up in there, and we didn't take our profits when we should have. We should have taken our profits at X1. But we just kind of sat on it. Now the market's turning around and going back up. Wow. That didn't come down far enough for us, did it? Okay, put in your Fibonacci ruler. We go all the way up here. Where did it come down to? Look at this thing, same thing. It didn't get down into the sweet spot. Went too far, too fast. Didn't come back down, not even to 38.2. So there were a whole bunch of orders to buy right down in here, and it never did come down. So up it goes. So if we come in here, Fibonacci ruler, 1, 2, 3, just like that. Where's it going to go to? Well, we think it's going to go. Lan, show me the settings to that projection tool. Mine doesn't look like yours. Okay, hold on. Let me do that. Let me get out of the way so you can see it. Get your cameras ready. Get your phone camera out. I'm going to show you the settings for my little Fibonacci 1, 2, 3 tool that gives me these projections. All right, because it doesn't come out of the box like this. Get your camera ready. All right, so this little tool right here, this is the Fibonacci projection tool. I use it religiously. All right, so we're going to come to our preferences. Snap those pictures, snap the camera. I'll slide it down so you can see the rest. You got it? All right, there's the bottom side. Snap another picture right there. So those are the settings for that tool. Okay. All right, one more time, up to the top. Snap your pictures. Make sure you got it. All right, you can put that in there now on your software. So that little tool is our little projection tool that shows us where these markets go. All right. And we're going to expect it to come. Now it's not going to go straight up. It'll make a little, this one did, straight up. So we're going to expect some little, tuffets in here, little pullbacks, but that's your little opportunity to get down on. This is the B1, or this is B1, this is A1 down here. This is B1 right here. So there might be some B2s, B3s, B4s, and then we're going to wait for it to break the blue light, right? So this is X1 right here. That's the breaking of the blue light. When it breaks the next blue light, it'll always do it, guaranteed. It'll break the next blue light. We just don't know where. All right, X2. So that'll be your X2 going into the third drive. And we expect that to happen up in here somewhere. So this is the next run. Okay, so that's Cisco. Natera. We just got long positions in here. I got to go a little faster. We'll leave that one. NVIDIA. Oh, still hasn't broke the blue lights. Will it? Yes, it will. Look at them zoom in there, coming together. It'll break them right up in here somewhere. We're going to leave these positions on. Well, let's see. We don't have any. Oh, we're up $100. What's the max profit? Oh, we could receive a lot more, though. Oh, we paid $14.18. There's about $400 in there, and we're only up 100. I'm going to keep those. I'm not going to take that 100 off the table because I think we're going to get a break in here. I think NVIDIA is going to break those blue lights at some point and flush back down. Now, is it going to flush all the way down? You got to put your Fibonacci ruler at the very top and at the very bottom. And that's where they're going to set their orders. All right. That's why you do this Fibonacci thing. It's like, Lan, what's the Fibonacci thing? Well, the Fibonacci thing tells you where everybody's placing all their orders, where the quant systems will start to buy. They'll buy at 38.2. They'll have some more at 50.0, and they'll have some more at 61.8. That's where they put all their orders to buy if the market comes down. So will the market come down? Well, it depends on retail traders. And they want the market to come down so they can buy more, so they can shoot it back up, make a lot more money. 38.2 is their starting point. Now, they'll start in here at 23.6, depending on what their algorithms are telling them. 23.6, there might be a few orders in there. And that's been paying off on some of these earlier ones because they just haven't been pulling back, right? They haven't been like AMD. Didn't pull all the way back to even 38.2. So did they get a few shares? Yeah, they probably bought a few at 23.6, which if you draw that in there, 23.6 on this one. See, it's right there. That's as far back as it pulled. It only pulled back to 23.6 and it started to go. So they didn't get very many shares. They did get some at 23.6. NVIDIA, it's got to pull back. All right. So don't buy it right now. Everybody's, I'm buying it. Oh, I love NVIDIA. NVIDIA is going to the moon. I'm buying some right now. I'm getting in. Don't get in right now. Whoa. People, don't buy right now. Wait for it to pull back. Buy the dips. Where are they going to be buying? The big quant systems are going to be buying here, here, and here. So you might want to buy there too. All right. Palantir, another one that didn't pull back to even 38.2. If we put in our 28.6 in there, I'll bet you there's a little, there it is. There's a little bit of buying right there. 28, 23.6 right there. Right there. There's a little bit of buying happening. It didn't ever pull back. That was frustrating for me because I bought a whole bunch down in here. We've talked about this. I bought a whole bunch down in here. I wrote it up and I wanted it to pull back, and I got out of almost all my positions right up in here. and I was waiting for it to come down so I could get in and buy some more, and it's going without me. So I feel bad. So that's one of the disadvantages of playing this system. If it doesn't come back and you don't get a chance to buy back in, and it just takes off without you, well, now you got a small hand. And that's what's happening to the big quant systems. I can guarantee it because I trade just like they do. So I am sitting here with a small hand at the top of this thing going into the next drive. I'm not going to have as many shares to sell out up that drive. So I don't think it's going to be as strong. So it's going to probably break a little earlier than we would like to see, like 100, 90, 100, 160. It's probably certainly not going to go to 130.9. They don't have enough shares to sell out. They didn't. I don't know. You never know. They could have bought like oodles and gobs, but I don't know. There wasn't much of an accumulation opportunity in here. So I don't know. It's getting ready to go again right here. You can see it wants to go. It broke the blue lights. It's just frustrating that we didn't get a little bit further pullback, at least down to 38.2. So that's frustrating on Palantir. Now, on my yield max funds, I didn't ever sell out because that's a different model, right? We hang on to that one because we're just operating it like a little engine, like a little machine that makes money, a little printing press. But if you're going to buy low, sell high, it's a different strategy. So you trade both sides. Trade PLTR and PLTY. All right, there's PLTY. And this, remember, this is not, PLTY will still run through these same cycles and trends, but this is tied to the underlying of the PLTY. You're like, oh, this is perfect. Oh, buy a whole bunch right down here. Yeah, you can. But is it going to shoot up really far? No, not if PLTR doesn't. If PLTR doesn't shoot up really high, PLTY is not. PLTY is tied to PLTR. All right. So that's how that works. So this is just concerning to me. I really wanted to pull back a little farther so we could buy a whole bunch more shares, but it didn't. All right, RKLB. I can't sit there and whine over spilled milk. Okay, we just got a few shares in here. We bought this one and it's dying on us. What the heck is going on with Rocket Lab? I ain't going to lose any money on Rocket Lab. It's not worth it. So we'll just pull that up to break even. Just leave it right there. If we get stopped out, we get stopped out. Who cares? Shy. All right. Now, you all read the Pitt News magazine about Shy, right? The iShares, this is the bonds. So if bonds go down, stocks go up. Stocks go down, bonds go down, up. So this is drive one, counter trend, drive two. So we got a nice little Fibonacci projection. This is positive for the stock market, right? Did you all read that article in Pitt News Magazine? Speaking of Pitt News Magazine, have you guys seen the new ad? Let me show you the new ad for Pitt News Magazine. Let's see, where is it? Right here.
You know how some people read Pitt News Magazine for the charts and strategies? Me? I started reading it for the pictures. And now I write for them. Go figure. If you want trading content that's smart, useful, and doesn't put you to sleep. Oh, and occasionally features me making up terms like tail fuzzies. Head over to pitnews.com and subscribe. And hey, if you find my picture in there, don't judge. They caught me mid-espresso.
All right, are you guys subscribed to Pitt News Magazine? There's a great article in there about Shy, SHY. Jordan Black wrote an article about Shy. If bonds are up, stocks are down. If bonds are down, stocks are up. All right. So you want to make sure that you have that article. Go read it if you haven't. There's also a podcast about it. I think that Claire did a podcast. Speaking of Claire's podcast, while we're running ads, we might as well listen to Claire pontificate about her podcast. How's that?
Hey, Claire here. Guess what? Mr. Turner handed me the mic. I've now got my very own podcast, Pitt News on Air, your new weekly hit from Pitt News Magazine. Join me every Wednesday for stories, interviews, and a little behind-the-scenes scoop. We're live on Spotify, and yep, now on Apple Podcasts, too. Visit pitnews.com to follow. Come hang out with me and the gang. We're all there. Jake and Lena, of course, Lan Turner, David Duty, Dr. Scott Brown, Jordan Black, and even Aiden shows up on occasion. We're having a world of fun. Don't miss out. Pitt News on Air. Because news should never be boring. It's where your trading friends are. Follow us wherever you get your podcasts.
All right. don't forget to go over to pitnews.com and get your podcast. All right. I think a new one got dropped today. So every Wednesday. Is today Wednesday? Oh, not till tomorrow. You got time to go get subscribed so you can watch and get your podcasts over at pitnews.com, both podcasts and the software. Of course, you wouldn't want to miss this.
Look, if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
We would never use AI to get a celebrity endorsement. Never. All right, let's go down to the next one. All right. So let me go back to Shy real quick. This is saying that we got more downside potential on the bonds, right? So this is a nice little Fibonacci projection to the downside. We expect a little bit more downside. So if that's the case, we're going to anticipate SPY, which is the S&P 500, an uptrend. All right, and it is. There it is. There you go. So we've got a nice little uptrend right there. That's a B. Let's do it properly there, Lan. If you're going to do it right. B1. Okay, so there you go. So that's your B1 right there. This was A1 down in here. And we use the bonds, right, to help us identify that when bonds go up, stocks go down. Bonds go down, stocks go up. So there you go. Have we made any money over here? Let's go see. Chart's down. Oh, we're making money. We're making money. 237 on our long call. Our puts that we sold were up 145, 38%. The market's rallying. We're only up 38%, 40% on that one. We could take those off because, 20% is our goal, and we're already at 38%. But if the market continues to rally, we got 38 days left, and the chances of those things closing below that red line, pretty slim. And slim left town. So there we go. So I think we'll just hang on to them. And if the market flushes back down, they may drop in value. But the market would have to, the game we're playing here, carnival game is, the market would have to close below our red line for us to lose our money. And these are sold puts. So all that would do is just give us shares. We'd get shares down here. If we don't get our shares, well, they'll give us our premium instead. Give us the consolation prize, and which isn't so bad. 374 on that one, 257 on that one, 367 on that one. I think we're just going to hang on to them. All right. Bonds are going down, so we're going to anticipate a continuation of the rise of the S&P. All right. So here, Targa, we just got some long positions. Again, this thing's wimping out on us. I don't really want to lose money holding shares on a market that doesn't want to rise. Let's bring this up in here. We'll just get out if it breaks that low right there. Say bye, see ya, don't want to be ya. Okay, back to Tesla. We already talked about Tesla. Market starting to rise off of this low point in here. Are we going to see a big rally in Tesla? The quant systems would love to see that. It's just whether we can get retail traders on board. Elon's going to have to do something that a little less embarrassing to get the retail traders to start to buy so that the quants can start to sell out. What's going to happen there? Nobody knows. Nobody knows. All right. Tesla. Still holding some Tesla. It's still making money. All right. They're selling puts against it. All right. United Airlines just broke the B1. Still rallying. Oh, we're only in with shares. So we could bring this up. We could suck our orders in here. We just bring this right up in here. We'll come in we'll put it a break even. If it comes down and snaps us out, we won't feel bad. We'll just get back in again. All right, that's it. Let's go see just real quick. I know we're out of time, but I promised we were going to look at our 100 percenters so that we could see if there's anything else we want to buy because we freed up some cash, right? Don't we have some money where we can spend now? We do. We got $32,000 that we can invest. Oh my gosh, here we go. We finally got a break in GEV. Oh my gosh. There it is for us, folksy Roonies. We were waiting for this one clear back here. Look at how many little breaks we had in here. So we had our A1, A2, A3, A4. We had an A4. It just couldn't make it go at A4. So the little lower highs and lower lows, the ones in here where they pulled back like that, those are little half steps. Remember, we talked about those. See the little half steps in here where we got lower highs, but we didn't get any lower lows. That's Claire's fuzzy tops. Fuzzy tops and fuzzy bottoms. All right, there's another one. Got a lower highs, but not lower lows. So those are half steps. That's a full step. It actually got a lower high and a lower low, lower high and a lower low. Lower high and a lower low, barely. Look at that thing. Man, oh, actually, I don't know if that's a lower low, is it? It's not. Zoom in, Lan. Zoom in. Zoom in. You got to look. You got to see. Oh, let go. Let go. Get the right tool. Come on, drag it down there. I don't think that's not a half step. I mean, that is a half step. It's not a break. It's not a 4. That thing didn't make that's a perfect 3 drive pattern right there. Let's label it. Just come on, we got to do it, guys. I know. It's A1 right there. A2. That's why I turned off the bulls and bears. I wanted to show you that sometimes you get the red bars of these. And so the red bars are kind of little telltale signs. A. Take that away. Get rid of this. So there we go. So see those little red bars. Sometimes you get red bars. That's the telltale sign. That one didn't turn red. But that's our A2. This is A3 right here. And that right there, my dear friends, is not an A4. So that thing has a 3 drive pattern, just like right out of the manual. Drive 1, drive 2, drive 3. Break the blue lights. What's the blue lights? X1. I can't believe it. I really can't believe it. That is so classic. What manual, Lan? What are you talking about? The manual. Oh, yeah, the manual. Go get the manual. It's out on Amazon. It's my book. I write all this stuff down. People are like, Lan, have you written this down? Yes, I have. It's in a book right there, 238 pages. Full color, 8.5 by 11. Go out. You have to search Lan H. Turner, and it'll come right up. All right. So if you don't have the book, go get the book. All this stuff that we're talking about is in the manual. All right. Back to here. Okay. So there we go. We broke the blue lights. I told you it'd break the blue lights. You're like, no, it won't. That market's too strong. It will never break the blue lights. Yes, it will. I promise you. Every market always does. I can't believe it was a perfect 3 drive pattern. That's crazy. Let's put in our Fibonacci ruler. Where do we think it's going to pull back to? Where are we going to be buyers? Well, you can put in that 23.6, but I don't usually buy there. I'm a little bit more cautious and careful. I don't like it. But this market could deserve a little purchase time. Come in here at 23.6. I don't know if you want to do that. I'm going to probably wait for 38.2. I don't know. If it doesn't get all the way down to 38.2, we might wait for the first green candle to make a new high. And wherever that happens is where you're going to want to put a little piece in there. All right. It comes down to 50. If it comes down to 60, I doubt it'll come down to 61.8. In fact, if it does come down to 61.8, I'd be a little bit nervous because I'm like, man, this market's way too strong for this thing come all the way back down to 61.8. It should come down to 38.2. That's where I want to start buying right there. I'd be a buyer at 38.2. Yes, I will. All right, that's it. There we go. Hood. You know what Hood is? That's the little brokerage firm app. They were in the 100% club. Can you believe that? That's crazy. So there's your A1, A2, A3. See how they're turning red? See how they're turning red? That's why I turned off the bulls and bears, to show you that sometimes that you can build, instead of turning yellow, they turn red. Instead of going neutral, they just turn red. So that's how you can see your little A2s, A3s. A4 didn't go red. It's going to break. It's got to break the blue lights. Lan, this one will never break the blue lights. It will. Trust me. Trust me. Guarantee it will eventually break those blue lights. And then how far is it going to come back down? Well, this was the previous high. That's why we have the Donchian channel on there, because I just set that up kind of like a Fibonacci ruler. But we're going to go off this bottom here all the way to the top. And then where would we be buyers? We would be buyers when it comes back to 38.2. And we'd be buyers again at 50. And we'd be buyers again at 61.8. Is it going to come all the way back down there? Nobody knows. I don't know what it's going to do. Fibonacci line 23.6. If you think it's strong, you could buy at 23.6, but I don't like to buy up there. That's buying high to me. I'd rather buy back down in here in these little pullbacks. My favorite would be down here at 61.8. But if this market pulled all the way back down to 61.8, I might be a little nervous. Why in the heck are you pulling down to 61.8? You're supposed to be a strong 100 market. But anyway, that's just the Fibonacci sweet spot. That's our favorite place to buy, right down in there. Start accumulating, buying up right in there. Back up the truck, because this baby is in the 100% group. There's another one. Broke the blue lights today. Broke the blue lights today. You want to count it? I'll let you count it on your own. We're just going to look at these together. Where are we going to be buyers? Same thing. Same thing. We're going to start to buy when it hits 38.2. All right. Interactive brokers, same thing. Same thing over and over and over. You know why trading becomes boring after a while? Why? Because it's all computerized. The big quant systems have been computerized to do this, and the market just does the same thing over and 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 over again. It just gets boring after a while. Okay, I guess it's time to buy. Okay, I guess it's time to sell. Okay, I guess it's time to make money. Look at that. Nice little break right there. Market went up, pulled back. Where'd it come back to? 38.2. Where did they start to buy? Right there. Why did the market go back up? Because it pulled back, give them an opportunity to get in, and up it went. Crazy, crazy, crazy. It's all programmed into the computer. The thing is that the stock market has become way more predictable nowadays than it ever has been in the past. Way more predictable nowadays, easier to predict markets than it ever has in the past. Why? Because the markets are more computerized nowadays than they ever have been in the past. MSTR. Where's it going to come to? 38.2. Rallies up, breaks the blue lights, come down to 38.2. We all buy in, goes up, breaks the blue lights. Where do we think it's going to go to? We go from here, Fibonacci's tool, just like we showed you the settings to, and away it goes. Let's get rid of some of these white lines. Man, Lan, you draw arrows everywhere. And where do you make money? You just buy right there. You get rich, rich, rich beyond your wildest dreams as it goes up to the next level. And this is drive 1. This is drive 2. It almost looks like this is drive 1, doesn't it? I'm not going to call that drive 1. It's too small. I'll call that drive on the way down. This is drive 1. Counter trend, drive 2. And we got this ugly little thing in here. What the heck was that? This is drive 1. This is counter trend. This is drive 2. Technically speaking, this really is drive 1. Why? Because this is the low right here. And it didn't break it. Came down and touched it, but it didn't break it. It is what it is. That's drive 1. That's drive 2. This is drive 3. All right, it is what it is. Misty. This is the yield max version of MSTR. So we're going to anticipate a rise in price on MSTR, which means we're going to anticipate a rise in price on MSTY. So if you guys ever wanted to get into MSTY in the yield max funds, now would be a good time right in here. Okay. We're going to anticipate a rise in price. I mean, it's going to go? No. It means it could fail. This really has a lot to do with Bitcoin. And don't ask me about Bitcoin. I don't know jack shit about Bitcoin. All right. Been playing with it my whole life. Never, I made a bunch of money on it. I can't badmouth it too much. When you make that much money, you don't want to badmouth something. But I think I was lucky. I just, I did a couple of things right accidentally. I accidentally did the right thing on Bitcoin. I don't know anything about Bitcoin. Not my world. But that's what MSTR is, MSTY. I make a lot of money on my MSTY. I certainly do. And if you guys want to get in on it, now would be a good time. It's just right there at the buy zones. But it's Fibonacci buy zones on the MSTY. I don't know. Is it going to go down from here? It could very well continue to go down. MSTR everything's giving a signal that it should be going back up, right? I mean, that's what that's telling us. We've just broke the blue light. That's a B1. B1. We love B1s. B1s. But that would mean Bitcoin's going to rise in price. I hope Bitcoin rises in price because I sure got a lot of it. Sure got a lot of it. All right. NTRA. Terra. That's just shares. We just got a few shares on this thing. It went up and it touched the previous high. Let's do this. Let's just suck our stop all the way up there. Let's say if you break down, we're just going to get out of this one. This doesn't feel real strong to me. This is supposed to be 100%. Or why is it giving us this? Well, it is a little B2. It is what it is, Lan. It is what it is. Just call it what it is. Call the game like you're the umpire, all right? Just call the game. You don't get to choose whether it's good or bad. It's just what it is. That's a strike right there. All right, NVIDIA. It's got to break the blue lights. We already talked about that one. All right, Palantir. Palantir. We talked about Palantir. I really want back into Palantir. I really want back into Palantir. I thought I was going to get a better opportunity to buy some more. So I'm going in with a weak hand. Weak hand going into Palantir rally. But look at this ugly thing. It broke the blue lights once, pulled back down, broke the blue lights again, went back up. Looked like it broke the blue lights again today. We'll have to see tomorrow if that was an actual break. Looks like it. I don't know. It's being stupid, isn't it? Might be a good opportunity to load up. This might be an accumulation stage. They might be just this. This looks like an accumulation stage. It's all green down here. They're saying buy, buy, buy. This thing's probably going to explode out the top. This company is on fire, man. This thing is on fire. We're going to probably wish we had a call right in here. At least one. Let's come out to 129 days and see what their volume's at. Volume, let's go to 100 days and see what the volume's at. This is about the same. 129. So it's 1,900. It's 2,100 for $100 for an extra 30 days. That's worth it. Let's put that on. Let's come down into the money just to one click. 2,357. Let's buy 3 of those. Can we afford 3? Yeah, we can afford 3. We got $18,000. Let's get 5 of them. What if it flushes, Lan? What if it comes way down here? Well, then we'll wish we hadn't done this. All right. Oh, you do not have enough buying power to buy 5 of them. I thought I did. Buying power is only 18,000. 29. How much buying power do I have? I thought that I had plenty of buying power. Let's just see if it'll let me have 3 of them. Probably because I closed everything out and got all my profits today. It's not giving me these. Oh, it's going to give me that one. It's just not showed up yet. It's slow. Come on. We'll come back to it. I bet it's there. It's just slow. All right. PLTY. You want to get into some PLTY? We're getting into PLTY. See, there it is. It came in. So we got our long call. We got 3 of them. I didn't want it there. Oh, damn it. I wanted it down one click. Doggone it. That screwed me up when it didn't give it to me the first time, and then I wasn't paying attention the second time. I wanted it one click in the money. Oh, well, it is what it is. PLTY. You wanted to put some PLTY on and in PLTY? Now's the time to do it, folks. Right there. Look at that baby. It came down to 50. You had an opportunity to buy it there, and you missed it. So now you got a little opportunity to put a little in here. It's a couple green bars. This is a perfect little pattern. I could go into our little sheet and show you the pattern. That's like a classic pattern right out of the book. Right there. That's a buy signal. Big time buy signal. Buy, buy, buy. But that's, again, it's on the PLTY, which is tied to PLTR. So if PLTR doesn't go, PLTY is not going to go. So this is reliant on this one. Doesn't mean you're not going to get your dividends. You certainly will. So it just might flush again. If this one flushes, then that one will flush. the cost of your machine will go down, but you'll still get your dividends. And it's paying good dividends. You want to see how much it's paying? Let's go over. I'll show you. Where is it? Here it is. Let's go back to here, pull up our PLTY. What are our dividends on this baby? Right there. $7 a share. Ah, holy smackaroli. But it is $65 for a share. But it's $7. They give you $7 for every share. You want to do some fun little math? Why not? Let's do some math. Pull up your little math calculator. Let's do some math. Let's say we put $10,000 in there. 10,000, 1, 2, 3, divided by 65.10, 65.10. That would give you 153 shares. Okay, 153 shares, and they're going to give you $7 per share. That's easy to calculate, times 7.044. Get it exact. That's $1,000. So you put $10,000 in there, they're going to give you roughly $1,000 every month. I know, unreal, right? Unreal. But what if it goes down? Well, your $10,000 will go down, but they'll still probably give you something close to $1,000 anyway. So even if it goes down $1,000 every month, let's say the share price continues to fluff, and it goes down $1,000 next month. Well, they're going to give you roughly $1,000 in dividends, and it'll be a break even. And then it'll go down another $1,000. Okay, well, they'll give you another $1,000, and now you're again at break even. Then it goes down another $1,000. Okay, well, then they give you another $1,000 in dividends, and you're still at break even. It's probably one of the safest things you can do because the dividends are so high that the market can flush $1,000 and you still didn't lose any money. But is Palantir going to flush 3 months in a row $1,000 3 months in a row? Probably not. Could it? Sure. I mean, anything's possible. I mean, somebody could light off a nuclear bomb and the whole thing dies out from under you. But if that's the case, then you don't need your money anyway, right? So go put that $10,000 in there and make $1,000 a month. $1,000 a month could be life-changing for many people. That's all I'm saying. That's all I'm saying. It's what I call UBI, Universal Basic Income. Everybody's concerned that AI is going to take their jobs. Well, go put $1,000 in here and get your UBI. You can put your $10,000 in there and get some UBI. Are there higher ones? Yeah, there's some that'll even pay higher than PLTR. It's just that PLTR is on fire. It's a stock that's just absolutely on fire. I don't think this thing knows how to go down. I mean, it went down here, but that was, we all know what that was. That was the fluffer do. So could it do it? Yeah, it could do it again. It can always do it again. I mean, there's no guarantees in this world, but this is one hot little market. And could you wait? Could you wait for it to come back down to 31.2, 68.2, 70, 69.8, 50, 38.2, 61.8? Yeah, you could. You could wait. But you might have to wait till the cows come home. All right, let's go on to Rocket Lab. We already looked at Rocket Lab. Didn't we move our stop on Rocket Lab? It doesn't look like we even have a stop on Rocket Lab. We don't. We're long stock at Rocket Lab at a, this is a, wait a second. Why are we in the B drives already? That's a C drive. Look at that. Holy cow, we're already in the C1 on Rocket Lab. Holy cow. I don't like that. I do not like that, Sam. I am. How many shares do we have? 10? Is that 10 or 70? Can't tell. Positions down here. Oh, it's 70. Trade, 70 shares. Let's put in 70 here. Stop. And we're just going to put that right. I don't trust it. It's a C1. Do you trust C1s? Hell no, I don't trust C1s. I trust C1s a little bit. Just not a lot of it. All right. SMCI. Well, we're coming into the, that's A1. It's not broke yet. This is ugly. Really ugly. It could go again right here. Just put your progressive trend line in there, and as long as it stays above the trend line, stay in. We're only on an A2. I mean, this is just really ugly right through here. What the heck happened to Super Micro? I think Super Micro also, don't we have a yield max on Super Micro? SMCY, I think, don't we? SMCY. SMCY. Don't we? Yeah, we do. It's just going sideways. What's their payment on that thing? $1.58. But it's only $18. So let's put let's look, that's 10 grand. Let's put $10,000 in there. 10,000, 1, 2, 3. Let's see, divided by 1898, 18.98 equals, that's 526 shares times $1.58, 1.58. They're going to give you $832. Not as much as PLTY. And this market is not on fire like PLTY. Look how flat it is. What was the share? What was it last time? $1.41, $1.58 went up, $1.50, $1.97, $2. So see when you get a lot more volatility, it goes higher because look at that $5 on that fluff right there. But when a market slows down, calms down, they don't give you as much money because of all the options. They're selling options, right? So the options premium goes way down. When a market's wild and crazy, that's when you get higher options premium. So Palantir is a little bit fluffy too. They're a little bit soft this month. So our dividends are probably not going to be as high. How do I get back? Like that. So our dividends are probably not going to be as high on SMCI. I think I actually have some of that. Should we pull it up and see how many Lan has in his real money account? We ran out of time. I was going to do UBI today, but we're not going to have time to do UBI today. This is my real money account. I'll show you my real money account. Snowy. Oh, I have. Isn't that what it is? SMCI is Snowy. Oh no, SMCY. Oh, I have Snowy. I don't have SMCY. Do I have it in my other account? In my IRA. Maybe I have it over there. I thought I had some of this. No, I don't have that one either. What about my Roth? No, it's not there. What about in my SEP? I thought I had some of this. Nope, not in my SEP. What, my HSA? I swear I got some of this. It's not my HSA. What about in my wife's account? No, I know it's not in hers. What about in her Roth? It's not in hers either. Oh, man, I got like 10 accounts I have to look through to see, but I thought I had some of this, but I guess I don't. All right. Did you see the new spreadsheet? I need to tell you guys. I posted a new spreadsheet again. So if you guys went and picked up last time, I told you I posted a new spreadsheet. Here it is. Let me pull it up real quick. Here's the new spreadsheet for you guys. That last one I showed you was my real money account. This one here's the classroom account. So there's a difference between the two. The two spreadsheets, I just updated it. Oh, look, this has got a problem in it too. Over under parity. Uh-oh. Don't go get it. Something's wrong. Parity's broken. So to fix it again and post another update. All right. Sorry, guys. I just do my best is all I can do. And then I'm just some ding dong on YouTube. Okay. So the idea here is we've broken these down made it more consolidated. So you can see each little unit here is your infusion and your dividends. And then the totals down here. And then I've redefined parity. And the reason that this spreadsheet is a little bit different than mine is because my account that I started doing the Tesla or the Yield Max funds in was already like 5 years old, and I had lots of trading going on in that account. And so when I started doing the yield max funds, I had all this other predefined money. So I had a lot of blended money is what we call it, right? So I had made a bunch of profits, and then I had taken those profits and reinvested them. That's called blending your money. So if you go down and you work at McDonald's, or in my case, go down and work at a gas station, right? If you go and work at McDonald's and you earn money and you invest it, that's your initial investment, okay? So up here in the left-hand corner, you can see I've got initial investment. This is money that you brought in from outside, okay? It's not reinvested profits. If you reinvest profits and you put it into something, then you're going to have blended money. My spreadsheet is loaded with blended money. And so it causes a real heartache. You have to go through and kind of just decide. You have to say, okay, July 1st, that's when I started doing most of this yield max stuff. So I cut mine off at July 1st. And now I've got all this blended money. I don't know how much of it is money that I put in versus how much money I earned. Because your stupid brokerage firm doesn't track that. They don't know. It's really hard. It's nearly impossible. In fact, it's impossible to track, right? So, but if you start fresh like this and you say, I have no account and I'm opening up my little account first, and then I know how much money I put in my $10,000, and then everything after that is new money. I know that I started with 10 grand. And then when I start to blend my money, I can still keep that 10 grand as my number. So in this case, we started with 155 grand. All right. So we have our initial deposit. We know how much we put that in there. And then everything else that comes in is blended money. So it's infused money that's put back in. So I'm trying to break all that stuff out. All right. That's what all this stuff across here is. So you got all this stuff. So you got all this blended money. And then parity is, I've got a new definition for parity for you. All right. So parity is how much money you put in initially, and then how much blended money, profits you put in. And when you put those two together, you have a number. Now, it's not your profit and loss number because it would only be based on your initial profit would be your profit and loss number on your initial deposit, right? Does this make sense that you have this blended money coming in? And then parity would be, well, I've got this much money put into the market. It's blended. I don't know how much of it. Well, I do. And here I can track it. In my account, I can't track it. It's all blended money. I don't have any initial investment. So I'm trying to figure out the two spreadsheets are separate. You may be in the same situation as me and you might need a different spreadsheet, but this is the one I'm giving you. So you're going to have to specify an initial deposit, and then the rest of it's going to be blended money. And then you put your blended money in there, and then you end up finding out how much money, and that's what parity is. So parity is saying if you want to be above blended money versus being above initial investment. So you have two profits and losses. All right. And so I thought I had my blended money fixed, and it's all screwed up. So I'm going to have to fix that before I check it. I'm going to have to post another one. So don't go get it. I'll let you know. I'll probably do that today. All right. Anyway, be careful. You have blended money. So there's also articles in Pit News Magazine about blended money. And let's make sure you guys all go get your Pit News Magazine. All right. So there's SPY. We talked about SPY. We're long SPY, short SPY, going into the B1. All right. So AT&T. AT&T. If you want to get into AT&T, I think AT&T must, well, it's in the 100% club. It must have been a 100%er. I don't know if it is or not, or if I just stuck it in there. But it had a big run. I think it is in the 100%er. But it's that. Look at that. It's popping right now. It's popping out of that triangle formation. And they give a dividend. It's a shitty one, but they give you one. It's as far as a real dividend goes, like real dividends, not profit from options, but a real dividend, profit sharing. That's what a dividend is. Yield max funds don't give you dividends. They give you profit sharing. They give you what we call distributions. But they do it through the dividend process because that's the only mechanism available to them in the stock market. So they give you a dividend, but it's not a dividend. A dividend is profit sharing of the profits that the company makes. Well, these guys don't make any profits. They sell options and collect the premium and then give it to you. That's not company profits. It's profits that they made, but we call it a distribution instead, just to be split hairs. All right. So we're going to go into AT&T. And you can see that they give you a dividend. And as far as dividend paying stocks, it's one of the best. All right. So they give you 27 cents for every share you own. Let's do $10,000 since we're running comparisons. All right, so we're going to take 10,000, all right, divided by the number of shares, 28.6, 28.16 equals 355 shares times, they give you 27 cents every quarter to, I got to back up, 0.2, not $2, 27 cents, 0.278 equals. So they're going to give you $98 on your $10,000 investment in AT&T. They're going to give you $98, not every month, every 3 months. So you have to divide that by 3 to compare your apples to apples divided by 3. That's $32 a month versus Palantir giving you $1,000 a month. Okay, that's the difference. Now, do you think that you get $32 versus $1,000 without taking on a little bit more risk, a little bit more volatility, a little bit more movement up and down in the market? Do you think you're going to get more volatility with your $32 a month or a little bit more volatility with your $1,000 a month? Probably with the $1,000 a month, right? But is it worth it? Are you willing to sit through a little bit crazier markets for a little bit more money? Maybe, I don't know. It's up to you. I can't make that decision for you. All right, I think we're about winding it down. It's been a long class today, but some of you like the long classes because you're really into this stuff. Like me, I'm really into it. I'm kind of into it. Some of you, not so much, and that's okay too. Just go buy your Palantir and don't do anything else. Go spend your money. That's all you have to do. All right. This is Flushing Back. It broke the blue light. And hold on a second. All right. So that's not good for Toast. Toast is not breaking higher on the blue light again. It's pulling back today. But that's all right. Don't fret. If it comes back down into here, it might break the blue light again. That's what Palantir did, right? And it just might wander sideways for a little bit through what we call a reaccumulation stage, right? That's the big boys saying they want in, but it's not fallen down far enough to buy down on these opportunities to buy in, right? They got their orders sitting there. They'd be happy to buy some in there. Their quant systems would buy. But if it just wanders sideways like this, they'll go through a reaccumulation. And then it'll pop and take off and go. So I'm pretty confident that if that's what we see, that's what they're going to do. I've seen it a million times. All right. That's just out of just my observation. That's all I'm giving you. Just my observation. So you could do a little accumulation in here too if you want. You could wait for it to come back to some of these lower points. They'll buy down in here too. You can too. But it may not ever get down there. So they might just accumulate right up in here and then run it out in here. Either way, we can do something here. We want to. Let's look at an option and see. Let's look out at the 129 days. Oh, look, they're cheap. Of course, that doesn't mean, oh, look at the volume. That sucks. Let's see if there's any more in 100. Oh, there are more players at 100. Let's go 66. Ew, that's not good. 38. Not very many. That's good for us. That means that people think that there's more. 192, 220. Let's go. It looks like 100 days has the most volume in there. The spread is $15. $30 there. Do we want to do that? Probably. How much money do we have left? Ooh, not very much. I don't know if we'll let us have a couple of these or not. Let's see. Let's pop it down here. You think it'll let us have 2 of them? I don't know if it'll let us have 2 of them. I think it's going to let us have them. It's going to take a while. I don't know why it takes so long. Why does it take a while? Let's go to another market. Targa. Oh, I think we'll just sit on our hands on that one. Tesla. Well, we've already talked about Tesla. We're going to be big buyers on Tesla here. We can put. Oh, you know what? I'm disappointed in. We don't have any way of. We don't have. Oh, you know what? Let's go back to Targa. They give us our. Not that one. Toast. Oh, they did give us our orders. I was going to say we shouldn't put this money in here. We should put it in Tesla. Now I don't have enough money for Tesla. That's why you do it in the demo account first. Then in your real money account, you can change things up. Okay, we can come in here. Let's look and see. I do want to put some in Tesla. Oh, look at that. $40. Do we even have, it says we have $5,000, but I doubt it's going to let us have it. No. Shouldn't have bought that other one. Damn. 129 days. Why did it flip? Let's go to 100 days. 4,000. At the money, 4,601 step in. Think it'll let us have that? No, I want it right here. I want it right there. I don't think it's going to let us have it. We don't have enough money. Not enough buying power. It told me right there on the screen you didn't have enough buying power, Lan. Not enough. Oh, no. We don't have enough buying power to get into Tesla right here. 66 days? Not enough buying power for that one either. Where could we take some off? We could probably get some in there. I don't know. We're going to have to go take some off. That one's UI. Oh, there we go. Look at that. Hertef Holdings just broke the blue lights. So that was A3. That was actually an A4. So A2 point A1. That was our A1. Actually, A1. I called that A1. That stupid bar right there caused all kinds of grief. So this one I'm going to call A2. A2.5 because it didn't break the low. A3. That's A4 right there. But it's so close to A1. Well, Lan, you're the umpire. You're not the player. Just call it like it is. It's A4. All right. You're not the coach. You're the umpire. It's an A4. Okay, this is X1. All right, there's X1 right there. It broke it today. Where's it going to come down to? Well, we hope it comes down to 38.2. There'll be a whole bunch of buyers right in there. If not, if it just starts to wander sideways like the rest of them through here, we're going to have to do accumulation up in here. Possibly get something up in there, but we'll have to wait and see. We want it to come down here. That would be nice. 38.2 at least. There's our Fibonacci sweet spot right in there. Right? Okay, keep our eyes on that one. Same thing. Oh, look, Vestra did the exact same thing. Which one of these do you want to get into? You want to get into the one that's got the most volume and most open interest. So that was an A4. Look, it broke an A4. See the little red bars? That's why I turned off the bulls and bears. Got rid of the yellow bars. We lost the yellow bars, but this shows you the little red bars. So little red bars. And then I set this parabolic SAR up to look like the bulls and bears blue light. And then we got that. So you learned a lot today. Lots of really great settings. What are we going to do here? Well, we're going to wait for it to pull back to 38.2 or we'll start to be a buyer. All right. That's all there is to it. It's just the same thing over and over and over and over again. And if you want to practice, go back in time and look at these. Go back and say, well, what would I have done if I'd have done Lan's thing? It's not my thing. It's the thing. It's just the thing. It's not my thing. It's just the thing. It's like saying oxygen is my thing. I'm going to breathe today. I'm going to do Lan's thing. Oxygen is not my thing. We all breathe, whether you think about it every day or not. It's just the way things are. This is not my thing. This is just the way things are. I'm just telling you the way things are. I didn't make this up. All right. It's just the way things are. I'm just showing it to you. It's not Lan's thing. It's not my system. I don't have a system. I just show you what the system is that the big boys use. Lan's system. It's not my system. There is no system. It's just oxygen. This is the way markets move. I'm just showing you the way markets move. You can go back and just do it over and over and over and over again ad nauseum. All right. It just happens over and over and over again. It's what happens. It's just what the market does. I don't do it. I didn't make it up. I didn't make it up. I just learned it at the Chicago Board of Trade. Now I'm showing it to you. It just happens over and over and over and over and over again. Often enough that you can make money on it. I mean, that's all we're doing, guys. We're just reading the market. All we're doing is reverse engineering the quant systems. That's how they put them in there. How do I know? Because I was there when they taught them how to do it. I was there in person. I'm not telling you what somebody else told me. I'm telling you what they told me. All right. I was there. I saw the aliens myself. I'm not telling you that I talked to somebody who saw aliens. I actually touched the craft. I was there in the room when the aliens were speaking. I touched the aliens. All right. I'm not just telling you what somebody said that they heard the alien tell you. I was there to listen to the aliens themselves. I'm a first-hand witness of the Chicago Board of Trade aliens. All right, guys. I've had enough. Have you? I've had enough. Let's go do something else. Let's go count our money. If you had fun today, let me know. Hit the little thumbs up for the one or twos of you that are left. Oh, we still got a pretty good little group left. So nice to have you guys hang on till the very end. It's been a long day and a 2-hour class, but hopefully you learned something. And now it's time to go to the bathroom. All right. See you later.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.